40 years on, how do we look at some of the problems and challenges lying ahead when China considers seriously how to sustain its economic growth to commemorate the 40th anniversary of its reform and opening up? In the past 2 decades, the economic asymmetry of Asia has undergone a pronounced transfiguration that's emphasized by China. Its cloud has materialized the Belt and Road Initiative. As China moves forward towards a consumer-led and outbound investing economy, new manifestations of its new indispensable existence will arise. So how will Asia's other largest nations, such as India, react to and with China in the coming decades? And how essential is Asia in the pursuit of continued global recovery? To discuss these issues and more, I'm very happy to be joined here by Mr. Paul Greenwald, Chief Economist of Standard & Poor Global Ratings. This is Dialogue. I'm Yang Ray. As the Chief Economist of SP, I believe you must have followed the economic development of China over the past 4 decades very closely. So, looking back, in your estimation, what do you think are the most remarkable achievements typical of the Chinese national conditions? Because we are not a liberal market economy, we are not a liberal democracy, we have very strong central government. However, we do have a strong presence of the small and medium-sized enterprises as well as entrepreneurship. Look at the foreign investment, you know this very well, so let us know briefly your thoughts.
Well, I think that the growth has been spectacular and sustained. If you went back before Deng Xiaoping opened things up in the late 70s, if you ask some of the futurists or the experts in the early 1970s what they would foresee 40 years in the future, no one saw the rise of China, right? It was a complete surprise. We saw Japan and then followed by the tiger economies, but you know, China's it went from absolutely nowhere on the global charts to the largest economy in the world in a span of 35 or 40 years. So I think, you know, on the surface, that achievement speaks for itself.
What has made it possible that an economy that comes from nowhere suddenly became the second biggest economy?
I think there's 2 parts. One was the decision to open up, right? That was obviously the first one, but I think China benefits from something I call a late mover advantage. So China is one of the last economies that started to integrate into the global economy. So they were able to look at Latin America with a model of import substitution and relying on foreign capital. They saw some crises there and said, maybe that's not a good model for us. Or
so we keep a distance from the Washington consensus.
Right, but no, but you sort of pick the parts. It's like you know where some of the mines are when you're crossing the minefield. The Big Bang in Eastern Europe, when the Soviet Union fell, all those countries were encouraged to open up very quickly. The financial sectors weren't ready to absorb that, and they had various external crises. Then we saw the Asian financial crisis. So China, by being late in the game, is able to kind of maneuver around. They know where some of the dangerous spots are, and I think that's been part of the success, and the huge savings rates.
Don't forget the Plaza Accord that the Japanese was forced to sign in the 1980s,
right,
which led to at least 1 decade of stagnation. So do you think the Chinese government keeps this in mind clearly to avoid repeating the same tragedy?
I would put that in the category of lessons. 10 years ago, I was working for the IMF back then, but China had a very large external surplus. There were lots of concerns about global. The economy has been rebalanced. It's much more consumption-based, service-based than it was 10 years ago. That surplus has all but disappeared, so the pressure and the concerns are still there, but they're much lower than 10 years ago. So again, that's another lesson learned, and China's trying to, you know, weave its way through the minefield and make it from a, you know, a very agricultural country to an advanced economy.
Do you think with the lessons that we drew from Japan, the Plaza Accord, that China talks tough to the US government, which threatens to impose punitive tariffs on goods worth $50 billion US. And so what do you think of below the surface? For example, President Xi Jinping said in his opening speech in the World Forum for Asia that we would further open up our financial services and the auto industry in particular. Do you think this will be executed effectively under the stare of the world media?
You mean the strategy of opening up those sectors? Well, it's a process, right? First of all, your point that leaders speak to the domestic audience is always true. It's true in every country, but there's always other stuff going on, discussions about economic reform. U.S. and China is the most important bilateral relationship in the world. One of the concerns is the playing field for investment, right? If Sector X is open in the U.S. for Chinese investors, is the same sector open in China to U.S. investors. So I would expect continued progress across all of these things. Difficulties will come up, disagreements will come up, but the point is, both sides should keep talking, you find common ground, and you move forward. We're moving out of the phase where it was a trade story and a current account surplus story to it's an investment story. It's the whole of what we call the balance of payments. It's technology. It's opening up to investment. It's all that stuff together.
For years, bodies such as AmCham in China complained bitterly that they cannot enjoy equal access to the government procurement program. A capital account has not been opened. A lot of policies are not quite in favor of overseas multinationals. They say their golden days are over. So do you think, in this context, what President Xi Jinping suggested in his presentation at the World Forum should be viewed as concessions? Do you think this is a strong response to the bluffs from the U.S. government?
Yeah, well, the U.S. government is probably different from the U.S. Chamber of Commerce, right? So the U.S.-China Chamber of Commerce has a different, set of priorities. But you're right, they often talk about level playing field. They often talk about access to some of these restricted sectors. So I wouldn't call it a concession. I think it's a natural evolution. If we look at China on a kind of a real economy basis, if you look at GDP and trade, China is an enormous country in terms of its global share, and some of these variables, it's quite below average, and then that's the next phase of the Chinese growth story. So you would expect some of these sectors to open up.
Over the past 4 decades, the GDP growth rate averaged 9.5, as Xi Jinping outlined in his presentation. Now, we start to see new normal or slowdown of the and qualitatively China seems to pay more attention on digital technology, the fourth industrial revolution. But in doing that, I'm afraid China poses yet another more menacing threat to the U.S. government, who says, look, this is a battle for the primacy of digital technology. Do you think this again enables the U.S. to fall into the trap of Cold War or battle for world leadership?
Yeah, I don't buy that for economic stuff, right? The pie's getting bigger. China, by some measures, is now the biggest economy in the world. The U.S. is not going to do everything better than the Chinese, just as the U.S. doesn't do everything better than Europe. So you find your advantage in the global system, and you go with that. The growth rate of China, you mentioned 9.5. We would like to see that well, that's already come down a bit, but even 6.5 strikes us as a bit too high. In our view, it's too credit-driven. It's still too SOE-driven. So we've seen a big rise in the Chinese middle class, consumption driving growth, services driving growth. What's the speed limit for China in this kind of new normal, fourth generation, whatever we're talking about? We think that's probably closer to 5.5.
What do you mean by credit-driven and SOE-driven?
Yeah, well, let's go back to the global financial crisis. China was considered to be a low-debt, low-credit country. Fast forward 10 years, China's now a high-debt, high-credit country. China's gone almost an entire decade with credit growth faster than GDP growth, and that was never the case before 2008.
Is that a very bad indication?
It's not a bad indication, but it's not a sustainable path, right? So you can't.
Does it mean financial risks, systematic financial risks?
It means, yeah, it means that the economy has to find a way to allocate credit better and live with less credit, and to bring credit down in line with GDP growth. Again, the speed limit we came up with for that is about 5.5%. We think if the GDP growth were around 5.5%, then credit growth would fall in line with GDP growth, and that would be a so-called steady state for the economy. It doesn't have to get there in 2018. That's not a 2018-2019 forecast. But we think if expectations were managed down over the next 2-3 years, that wouldn't be a bad thing. That would make us feel better from a macro credit perspective, that the credit growth was better aligned with GDP.
I appreciate your balanced depiction about the financial risks, but obviously, on the agenda of Mr. Xi Jinping following the 19th National Congress of the CPC, 3 things got prioritized. One is the prevention of financial risks, the other poverty alleviation, a third is, of course, defense of the environmental conditions. Now, what are the things that you would call attention to in terms of prevention of financial risks? Because soft landing of whatever would be first and foremost the most important task for Mr. Xi Jinping.
Well, this is the way we look at it. Think of the economy, the growth as kind of building blocks. You have a consumption block, you have an investment block, you have a foreign demand block, people buying the things that China produces. The consumption block alone, which is the rising middle class story, gives China every year between 4 and 4.5 percentage points of growth. So if you just do a mental exercise, you turn off the investment story and the foreign demand story, China could grow by about 4.5%. Of course you're going to need investment. Of course China is still urbanizing, industrializing, moving up the value chain. But the credit-driven investment model, which still hasn't been dialed back enough in our view, is where we would go from the 6.5 to around the 5.5. That would, we think, neutralize a lot of the financial risks, put China on a more sustainable path. And it's very natural. It's part of this rebalancing of the economy toward consumers and toward small firms and services and up the value chain.
What do you think of the contributions of the domestic consumption to the GDP? You say it's around 4.5?
Right.
Oh, wow. Is it still a formidable figure?
Well, 2/3 of Chinese growth is coming from consumption. Mm-hmm. That's starting to look like a more normal economy.
Is that the major reason why President Xi Jinping is not afraid of having a trade war with the United States? Because after all, we have the continental economy, which means domestic consumption.
I'll give you a great statistic on that. I'll give you two great statistics. First, we put out a piece about 2 weeks ago. It was a field guide to a U.S.-China trade war. It was kind of a bit tongue-in-cheek. But one of the things I learned in this, and I hadn't noticed, 12 years ago, if you took exports and imports as a share of Chinese GDP, they were 65%. Last year, they were 35%. So China is a much more domestically driven country. It relies much less on imports and on exports than it used to, and it's a much more consumption, kind of almost a normal-looking economy. There's a long way to go to get the entire economy rebalanced, but on a year-to-year basis these days, 2/3 of Chinese growth comes from consumption. That sounds almost like an advanced country. So that's a good basis on which to manage the other parts of the economy to more, I think, sustainable levels.
What do you think of the prospects of having a devaluation of the RMB?
In the sense of what? Of helping growth. Yeah. Well, what happened a couple of years ago is the capital account was, becoming more liberalized. A lot of money was trying to leave the country, right? And for the first time, we saw China actually losing reserves. After reserves had been built up to $4 trillion US dollars, we saw money start to flow off. The reserves were used to kind of manage that process. And all of a sudden, China had $3 trillion of reserves rather than 4. And I think the PBOC and the government looked at that and said, well, $3 trillion is still a lot of money, but we don't want to kind of play with fire and see that go down sometimes by more than 100 billion per month. So then the sort of tiered controls were put in place in late 2016. The currency was depreciating at that time, not because of reasons for export competitiveness, it's just because a lot of money wanted to get out of the country. I think in general, the exchange rate gets overrated in terms of a driver of trade. The model I have in my head is currency explains about 1/5 of a country's trade, and what the rest of the world is doing is 4/5. So devaluing the currency is not going to help any country over the long run, export its way to prosperity. That comes from productivity, comes from reform.
Let's take a close look at the new dynamics in the Chinese economy, e-commerce.
Yeah.
BAT, for example,
yeah.
Baidu, Alibaba, Tencent, and other catch-up giants in the digital technology area. So what do you think of the possibility China will surpass the United States and becomes the most competitive digital leadership?
Well, in some of those areas, like digital leadership, e-payments, things like that, on some measures, I'm not an expert, but China appears to be equal or ahead of the U.S. Again, China's going to be better at some things, U.S. is going to be better at some things, Europe's going to be better at some things, Japan's going to be better at some things.
The Trump administration is full of hawks who vow to stop China from pursuing the digital leadership.
Yeah.
And admittedly, it is a matter of a Cold War. They want to protect and maintain the primacy of their digital leadership. But can China be stopped anyway?
Yeah, I'm not sure I want to go down that road of that particular strategy. You know, China's a big domestic economy. You've got a technology sector. You have a rising consumer goods sector. The payments and the e-commerce guys have already done quite well. So I don't get the mentality that they can be stopped. They're already there. And
latest estimation in the three cases of Zhejiang, Jiangsu, and Shanghai show clearly we are ahead of the average level of OECD in terms of government's input into the high-tech area for R&D. I mean, that showcases the determination and political agenda of the Chinese authorities to catch up very quickly in digital technology. Having said this, what do you think of yet another driver for the economy? Land revenue is no longer the hallmark for our GDP dynamics. So what do you think of this area? Do you think there's any overheating, any bubbles, any potentials? What would be the channels of revenue for the local governments, which depend very much, which used to depend on property development, but now it's not the case?
Yeah, well, first of all, those are two separate questions. On the e-commerce and the technology and all that stuff, that's the driver of long-term growth. The only thing that matters for long-term growth is productivity. So if China is investing, doing things more efficiently, moving up the value chain, moving up the technology ladder, that's a given. The local governments, that's tricky, right? Because they need financing. There's some sort of sharing arrangement with the center, but the land sales have been a big source of revenue. They're going to have to issue bonds into the public sphere. They're going to have to compete for that. So, you know, that's an area where we're going to have to see, you know, maybe a bit more financial discipline around some of the provinces, right? If you just can't sell as much land as you want, that's going to be some financial discipline, and that's tricky. China's system is different from the U.S., right? The U.S. has a federal system where states have their own budgets, etc., and China's a centralized system. So
perhaps the local debts are building up again dangerously. If you look at the boom of subway construction in the third and fourth tier cities, I mean, in the second tier cities it's no big deal, but in the third and the fourth tier, that's a big mistake, I'm afraid. But thank you so much for being with us. You are watching Dialogue with Paul Greenwell, the Chief Economist of SP. We'll be back in a short while. Stay with us, please. What do you think of the most viable options on the table for the Chinese?
If you look at the U.S. and China, neither one is really a trade-dependent economy. They're big domestic markets. They have domestic agendas. China cannot follow the same path as the U.S. and Europe in terms of energy intensity as it develops. It's got to find a much more efficient path. So there's actually an incentive to try to invest more heavily in some of these renewables, whether it's electric cars, whether it's wind, whether it's solar, and find a more energy-efficient path for China to rise upon. That's got to be a huge industry for China.
Welcome back, Paul. Now, we're not talking about whether it's correct or not to build subway systems in third-tier cities.
Right.
We're talking about the sustainability of the local economic development. What will be their growth points?
Well, think about the U.S., right? The U.S. is one country, but it's got a bunch of different economies. You've got agricultural sectors, you have tech sectors, you have manufacturing sectors. So different parts of China are going to do different things. Putting in public infrastructure is generally a good thing if there's an economic rationale. Third and fourth tier cities in China are probably bigger than most cities in the U.S., so I think there's a case there for public investment, as long as that lays the foundation for future growth. I don't know in every province of China what they're going to specialize in, but you know, urbanization ratio is only 50% in China, going towards 70, 75.
What about the service industry?
Yeah, exactly. It's going to be services.
50%?
Yeah. So that's the part of this longer rebalancing. So there's still a couple of decades till we get fully urbanized, till the economy moves to kind of a more normal structure where, you know, the share of the pie going to consumers is closer to 60% than 40%. But all that's going to continue to drive growth for a while. That's a reason why we're not terribly concerned in the short term about China, because there's so much infrastructure and public demand that needs to be met. So there's a path there for continued spending on those things. We're not building bridges to nowhere. That's the Japan problem, but that's several decades away for China.
Chinese leadership promises to cut back taxes. However, there are many areas where authorities at different levels need to spend more money, public spending. For example, poverty alleviation, protection of the environment, social security programs, and military spending. So, and also huge input into protection and restoration of a social order in Tibet, Xinjiang, you know. So, what do you think of such multiple challenges that President Xi Jinping faces?
That's, a lot of countries face those multiple challenges, right? You have competing demands for the public purse. You want to obviously spend for defense. You want to make sure everyone's got a floor or some sort of social protection. You want to spend in your public goods. So, you know, that's a decision that the Chinese government's going to have to make like every other government. You look at your constituencies and you allocate your capital appropriately. I think what's maybe a little bit different from China, this is an Asia thing more generally, is Asian countries like to run surpluses. They like to be self-funded. The U.S. has a different model, right? The U.S. runs deficits. The world likes treasuries as a safe haven, so it gives them what's called an exorbitant privilege to be able to issue lots of debt in their own currency. China doesn't have that luxury yet, right? So it puts a little bit of external discipline into the model.
What do you think of China walking the central line? We print money, we run default economy.
Yeah.
What's the ratio of M2? You know that it's over 250% of the GDP.
Well, there's two kind of problems with that. One is the global economy has to balance. For every surplus country, you have a deficit country. So if the deficit countries get bigger in terms of their deficit, the surplus countries need to get bigger in terms of their surpluses. The other thing is China is not some small marginal economy. China is either the first or second largest economy in the world. So what China does with its savings and investments and whether that creates a surplus or not, that has a big role in this constellation of global balances. So China can't do that unilaterally. All the pieces have to fit together.
Jack Ma is a big household name.
He is.
For China and for other major economies. Now, he is a symbol of e-commerce, online payment, innovative industries in our country. So let's look at the advent of artificial intelligence, big data, cloud computing. Now, do you think, for example, the remarkable improvement of automobiles with the combination of electricity and green technology will be the way out, and we're going to see a boom of the auto industry in China that will again give a catalyst for, or if not the driving force for China's robust growth?
Yeah, absolutely. I mean, if you think about electric cars, if you think about renewables more generally, a group that I sponsor in S&P, which is our China analyst group, we looked at this last year, and one thing that's kind of obvious, but I'll say it, China cannot follow the same path as the US and Europe in terms of energy intensity as it develops. It's got to find a much more efficient path. So there's actually an incentive to try to invest more heavily in some of these renewables, whether it's electric cars, whether it's wind, whether it's solar, and find a more energy efficient path for China to rise upon. That's got to be a huge industry for China over the next couple of decades.
The US government says they would employ anything short of a naked war in preventing China from pursuing digital primacy. Again, are you confident that China will go ahead anyway with all the macro policy, with all the macroeconomic policy options on the table? You said something like that a few minutes earlier, but we're talking about the driving force and the sustainability of the Chinese economy. Looking ahead, what do you think of the most viable options on the table for the Chinese?
Yeah, well, first of all, if you look at the US and China, neither one is really a trade-dependent economy. They're big domestic markets. They have domestic agendas. I can't speak for either government. I don't work for the US government. I obviously don't work for the Chinese government. But, they're going to pursue policies, whether it's technology or otherwise, that are going to benefit their economy. So I would expect the US and China, even if there's less cross-fertilization, to independently be pushing in those areas. It's in the interest of both economies. I don't see why that wouldn't happen.
The rise of labor costs has led to the bankruptcy of thousands of family-based businesses, the SME, in coastal areas such as Jiangsu, Zhejiang, Fujian, Guangdong. Now, the labor-intensive, low-value-added products are being removed from China to other low-income economies on our periphery. Do you think this is something good?
Well, that started with Japan, right? The Japanese academics came up with this flying geese model, if you've heard of that, in the 1960s. And Japan's the lead goose, and it got expensive, and it went to the tigers. The tigers got expensive, it went to China. China's not the last goose in the formation, it's the big one, right? But as China becomes successful, the types of things China was exporting 20 years ago when I first started to follow China as an economist, textile, clothing, footwear, that either moved into the interior of the country or it went to Southeast Asia, you know, Bangladesh, Vietnam, Sri Lanka, some of those other countries, they're actually waiting. If you think of the Asian economy as a system where Japan's the most technologically advanced, then followed by China, the tigers, etc., the guys at the other end, they're waiting for you to become successful and expensive so that lower end stuff migrates to their economy. So that's actually part of a system that makes sense, but it's a dynamic part of the economy. Sectors are going to have to exit when they're too unproductive for China, and you move up the value chain. That's how you become successful. That's part of the story.
This chapter is over, I'm afraid, Paul. Such low value-added products are also not very environmentally friendly, so it's not a bad thing. The last question is very much about, do you believe we're going to have a repeated financial meltdown? Since every 10 years we are likely to have a financial crisis. Look at what happened in 1998, 2008, this year is 2018.
I don't think it's automatic. There's not a 10-year rule that says you have a crisis every 10 years. For crisis, you have to have, this is me sort of putting on my old IMF hat a bit, you need to see excesses somewhere. You have excess borrowing, you have excess investment in a sector that's property, which is integral to the economy. We're coming out of this very deep financial crisis. The recovery has been pretty shallow. It has been a long recovery, but when I look around, I don't see the big excesses. That's probably the famous last words of an economist who's going to miss something, but I just don't see the big bubbles anywhere that are going to pop. That doesn't mean we're not going to have one in the future, but as a 2018-19 near-term forecast, I don't see the ingredients in place right now. Let's hope that's right.
Thank you so much.
My pleasure.
I'm impressed. Good job. Thank you so much.